Everybody, for showing up, taking time out of your day for this. It's been a little bit of time since we've had this chat. It's always great when you guys show up. Gabe's going to let me take this and see how badly I handle this. So, yeah, so a lot has changed and it's changing really quickly. So I think it's great to hear from your individual sectors and how everything's going. So I think what we usually do is just leave it up to you guys. You guys know what's going on. I think the big things going on right now, vaccine rollout, how that's affecting different industries. Michael, could you fill us in on what's been going on with retail?
Yeah, I mean, retail, obviously, when this first hit, it shut us down. I mean, all the restaurants were closed, hair salons, nail salons. It definitely feels more normal now. I was maybe telling somebody I've been out to dinner a couple of times, and they're not following the 25% or 20% rule. It's the 125% rule. I mean, the places are packed. So they're doing well, seating inside now, which is good. We are, as far as the tenant activity, it's been pretty active lately. I'd say the last 2 months, we've been slammed. A lot of activity, a lot of deals in the works. A lot of those, we have seen a little bit of fallout with some big boxes. That's been going on longer than the pandemic. I mean, it's been, 2 or 3 years where we've been kind of facing that struggle with big boxes coming available. Those are a little harder to fill up. Not as many big box tenants out there anymore. But if, I have a couple that have been on the market for a while, but a lot of those get filled up. I mean, there's someone who will come in and backfill it. You don't have to get creative, divide the space up, make a little sweeter rent deal, a little more free rent, things like that to make it happen. And then also the other category, which I mean, frankly, we don't have enough space for, is the quick service restaurants. Those guys, some of them I talked to are doing better than they've ever done. I mean, they've never done this well before the pandemic, and they're just killing it right now. And we have a lot of requirements for different quick service tenants that we just can't find a location for. Granted, some of those guys right now are looking for second gym space and trying to take advantage of someone else's improvements. So now they can get into a space for half the cost or maybe a quarter of the cost to open up a restaurant. But there is no shortage of quick service players out there looking for space, which is good. I mean, that's good avenue. We have seen rents come down a little bit. I think landlords are being forced to do that. It's either let the space sit or try to make it attractive for someone else to come in. And quite frankly, if the landlord doesn't do that, the landlord down the street's going to do that. They're going to do what they can to fill up their vacancies. And that has kind of compressed the rents a little bit. Not a whole lot, but I'm seeing rents, maybe 10, 15, 20% lower than maybe they were before. Free rent has definitely been extended. And part of that too is had a tough time getting permits through the city, which is understandable. I mean, a lot of the architects are working from home. Some of the city planners are working from home. And that's been a challenge. And the developers are still wanting to only give, 3 or 4 months. And it's taken a lot longer than that right now. So we're trying to kind of figure that into the equation when we're doing these offers and trying to get tenants in the spaces, make sure they're not paying rent before they're even open. So that's been somewhat of a challenge. The non-active category, I would say, is the sit-down restaurants. I mean, there's no sit-down restaurants poking around. There's probably a good 6 or 7 in Fresno and Clovis alone, just sitting there with no interest on them at all. So that's going to take a while, I think. Some of those are going to end up getting scraped, and they'll repurpose them for another use just because the real estate is good. But there's not a 5, 6, 7,000 square foot restaurant to come in and take those. That's just that animal isn't out there right now. So. I mean, all in all, it's been a challenge, but I think there's optimism out there. Tenants are out looking again, trying to make deals. So it's much better than it was, 8, 9 months ago, for sure.
Are we starting to see vacancy rates change?
What we're seeing is it's kind of segmented. If it's A+ properties, those spaces are getting jumped on pretty quick. Maybe some of the the C real estate, that's still just sitting there vacant. There's not a lot of players stepping up to take those spaces. And it's kind of almost, it's north of Shaw and then south of Shaw, kind of two different worlds. There's some exceptions to the rules. There's some stronger centers down south as well. But I would say by far and large, the good spaces are getting a lot of activity and getting multiple offers on them. The spaces that may not be quite as good, there's not as many players that take those, and they're going to sit for a while, which is a little scary.
You see the sit-down restaurants, they're just too big?
Well, I mean, they were starting to struggle before all this happened. There wasn't as many of them. They've kind of all gone to different concepts. I mean, part of that is, all the costs are going up. Minimum wage is going up. I've talked to a lot of restaurant guys that just say, we just can't afford to have 50, 60 employees anymore on the payroll. And it just doesn't pencil anymore. So a lot of those guys are trying to find a new format that works. Maybe it's a 2,500 square foot quick service concept that works better. I mean, there's exceptions to the rule. I mean, Pismo's does fantastic. There's certain restaurants, Five, Limelight, those guys are still doing good, but it's certainly not the norm anymore. And there's, I can't even think of, trying to think of a chain large restaurant that's really expanding. There's not many of them out there right now.
Any thoughts about the hazard pay for grocery workers coming? I think the council is going to be considering that early next month. We saw down south, at least some of those big grocers shut some of those stores. Any feelings about that?
Yeah, I think it was at Kroger or Ralph's closed 3 stores, I think, down in LA. Just said it wasn't profitable to keep them open anymore. So, I mean, that's concerning. I mean, we don't, especially in certain areas, I'm sure we don't want to see that happen. And then how do you decide who gets hazard pay? Is it just the grocery workers, or is it now the guys that, Home Depot, Lowe's? I don't know how you kind of figure that one out. It's not brokers. Brokers didn't get hazard pay. We didn't get that.
Perfect. Well, thanks so much. Thanks so much, Michael. Matt, what's going on with mortgages right now?
So I thought I'd just kind of go over the 4 asset classes and maybe rank them from sort of what's the hottest and most attractive to where we're seeing lenders maybe come back into the market. Obviously, and I'm sure Robin will touch on this, the multifamily market's pretty hot right now. There's not a lot of availability or even projects for sale. So I think that there are a lot of buyers that are headed there. And I think that it's very competitive for institutional and bank lenders. They all would love to put some of that in their portfolio. I think they consider it to be the safest asset class and one that is seeing increased demand with a lot of the housing shortage that's in front of us. So that's definitely probably the most attractive place, the lowest yields in the market for lenders to put money. I think a close second right now is industrial. I think institutional lenders are chasing that. I know Ethan touched last time on just kind of the supply chain expansion that's going on and a lot of the growth, even in our local market and across the US. So I think that low vacancy is driving lenders to want to do and place debt in that market. I think the other two, let's see, retail. Institutional lenders have been pretty hesitant in this. Recently, kind of as we're beginning to open up the market, you're seeing some of these institutional lenders re-enter mostly in the grocery anchored retail space. But they're looking really closely at tenant profiles, sales, customer base, whether or not tenants are essential or non-essential, and market demographics. I think that if an institutional lender is not going to do a retail deal, it's most likely going to go to a more regional or large bank on a recourse basis. And I think then you kind of look at office being the most challenging spot to lend right now. Most institutional lenders are super cautious as they feel like the needs are evolving and changing based on what has happened with the pandemic. And a lot of answers are still, we don't have answers yet. So they're kind of see what space needs are and growth needs and where we're going. I think most likely the financing you're going to get in the office space is going to be with a bank on a recourse basis. So that's kind of, you know, an overview of all the different asset classes right now.
So the Fed keeps assuring us that interest rates are going to stay low, but you know there's been a lot of rumblings about inflation happening. Are people starting to look ahead towards increased interest rates?
Well, I mean, you look at like the 10-year Treasury. I think it's around 163 today, and I think you know mid last summer, so maybe 9 months ago, it was at, you know, 55 basis points. So, I mean, the 10-year Treasury has gone up 1% in the last year. So I think as a whole in the market, we've seen rates move up over the last 6 months. I mean, historically, they're still low. You know, multifamily rates are in the, you know, you can get them in the low threes. And I think that, you know, you can get most stuff done close to 4% or better across the board. So there are questions about that. You pump money in, eventually you might have some inflation. So I think everyone's closely watching it.
And then what about loan time? What's turnaround time like on and getting approved?
Today in the commercial world, I would say it's 60 days from start to finish, from an application to a funding. It hasn't changed. You know, obviously every deal is different and unique, but just a typical multifamily deal can be done in 45 to 60 days right now.
Perfect. Thank you. Thank you so much. Thanks so much, Matt. Ethan, you know, tell us what's going on with industry. It seems like you guys can't be stopped.
Yeah, it's thinking back to 12 months ago, and I think when we started doing this, I know my hairline was different. It's been a long 12 months. Some of the things that we were concerned about, rent collection, you know, none of that really came to fruition for industrial. If anything, it was the opposite. We've seen rents actually move probably 10 to 15% in 12 months up, almost across the board. We effectively have almost no vacancy for space above 20,000 feet in the Fresno and Visalia area, which is basically the Central Valley as far as most users are concerned. As an example, I've got 3 50,000 foot requirements right now. Basically, there's nowhere to put them. These are companies that want to come to Fresno, and that's their first choice. Visalia is kind of a second choice, depending on where they think they'll get employees, but there is literally no space to put them in. Caveat to that is that, you know, these are companies that want 28-foot clear height. They need multiple docks, like a traditional warehouse space that we've generally had several of, or maybe 4 or 5 available at once. There is literally no space available in Fresno. You can take that almost down to 20,000 feet and have that be true. So that's actually, it sounds really good. It's not good for the market, really. It's having no vacancy is not healthy. We were trending that way before a year, 12 months ago, and it's just really exacerbated by what Matt was referring to, the changes in supply chain. Everything that, shifted online, has to come out of a warehouse, has to go on a truck, has to then go on a delivery vehicle and end up on your doorstep. I mean, there's just there aren't enough trucks. There's not enough delivery vans. There aren't enough warehouses. I mean, this is just across the board in California, and you could argue, nationally. So what we see locally, though, we just got approval less than 2 weeks ago, a settlement that the developer and the city completed for a new Amazon sort facility in South Fresno. That's almost 500,000 feet, almost 1,000 jobs. That was hopefully a harbinger of of future development in South Fresno and the ability to sort of navigate the competing demands of the city, the environmental justice advocacy group, as well as the neighbors in that area who are stakeholders, and so hopefully that will allow the development community to move forward on some projects that have really been stalled for almost 2 years. Had those projects not been stalled, there would be probably another 1 million feet of development in the pipeline and somewhere getting close to delivery, which would satisfy the demand in the marketplace. And the rubber meeting the road, or those buildings are where people go to work. And so the inability to deliver buildings, the inability to fulfill these requirements really ultimately means that, these are typically net plus new jobs to the community. They're not, generally a company downsizing from 200,000 feet to 100. It's what I'm seeing, companies that are either growing and or moving into the Fresno area. So those are lost jobs. I mean, they're just frankly not, they can't be filled because the companies don't have space. So that's been challenging, to say the least. And the pipeline for development is still basically in Fresno stalled. Visalia, it's a little bit different. However, Visalia's labor market is smaller, and there's some concerns that between the new Amazon facility going in there, UPS, and several other larger requirements, where's labor going to come from, which is ultimately going to be almost, and maybe even more so than location, important from the perspective of logistics related uses. And as the supply chain changes, this labor is incredibly important and will probably move to the front of the line when companies start to figure out where they're going to put more facilities. That's probably been true as a part of maybe their decision making in the top 3. But at least from what I hear from several companies, labor becomes 1A to location now. And that's a pretty significant change. And so maybe that labor comes from other types of retail businesses. Maybe it's going to come from, entry-level office type employees. We don't know, but that's a really critical component to companies picking a location now. In terms of other sort of interesting developments, the owner user market is as hot as it's ever been. Debt is available. Typically, these are owner occupied buildings. We're not seeing problems with appraisals. We're not seeing problems with values. Lenders seem to be recognizing that we're in an appreciating market for industrial in particular, and there's just no inventory. So I saw a recent appraisal on a building. The appraisal came in about 15% low. However, the lender via the banker basically made a discretionary call and accepted the value of the building at the sales price. So they wanted the deal, but they had to stretch for it from a lending standpoint. And that was an owner user deal. It was under $1 million, local bank. So, the trend lines are good. It's exciting time to see some changes in the industrial market. And, we have a new word for it. It's logistics. It's not just warehouses anymore. So it sounds pretty cool. But ultimately, this is where commerce is going. It was going there before. It just, we got compressed by 60 months in 12 months. And, it's not just Fresno, it's the entire supply chain across the United States and frankly, globally.
What are there any sort of remedies to the lack of land? Is there anything cities can do? They seem competitive to get those
Yeah.
kinds of projects.
Yeah, I mean, it's complicated. It takes time. You can't just install sewer and water lines overnight. So cities and municipalities have to plan for these things, somewhere in the 5 to 10 year range. And so hopefully, it appears that the decision makers in most cities value these kinds of projects, but infrastructure is a huge challenge. It's just, these projects need sewer and water lines. They typically need, a fair amount of land. They like to be close and proximate to the freeways, to transportation corridors. And so that leaves, not that many choices as you just sort of look up and down the 99. But those communities that can plan and can provide sewer and water will be communities that have the opportunity to grab some of these projects. And they're regional projects. I mean, just because a building is located in South Fresno doesn't necessarily mean that the employees are only in South Fresno. They could be in Selma, they could be in Fowler, they could be in Kingsburg. So, these do draw from a wider pool of employees. So, it's not a loss if a building goes to Fresno, if the city of Selma, has employees that can that will go to that facility, and vice versa.
Perfect. Well, thanks so much. Brandon, thanks for jumping on the call. Yeah, what can you tell us about office space? What's going on? Vaccines are rolling out, and any changes being made there? I think you're on mute.
Oh, sorry. I was on mute, guys. Trying not to interrupt anybody. But the office sector is still doing very well. I mean, considering what some of the projections were and what some of the concerns were 12 months ago, rolling into the pandemic, I think overall we've seen a wait and see approach with a lot of our clients and on the tenant side. I think there's still a lot of unknowns. The vaccine is rolling out. I think people are wanting to get back to work. I think we touched on this originally when we discussed the first time we had this round robin, and it's a situation where kids going back to school on a full-time basis is going to really impact how employees work through office space and things of that nature, because they're the most densely populated types of commercial real estate with employees. So until the schools get back open full time, you're still going to see a significant amount of employees working from home. Obviously, until the CDC kind of changes regulations, let people go back full time, we're still going to see a lot of people working remote. I think the big unknown, and a lot of people have the question, and not many tenants and companies have the answers yet, is going back, how are we going to go back? Is it going to be a situation where we leave a portion of our employees remote, we come back and be socially distanced in the office? Do we need more space? Do we need less space? I think the consensus is that everybody feels like they need less space, but that hasn't necessarily been the case so far. I would say most of the companies that have had leases come up in the last 12 months have done one of two things. If they knew they were going to keep employees home, they may have relocated, downsized in size a little bit, but those have been mostly smaller companies. In the realm of bigger, more national type tenants and larger local tenants in the office market, I think the wait and see approach has been kind of the play, signing short-term renewals, 1-2 year to see kind of when we can ride this thing out and what it's going to look like afterwards, and then be able to make some adjustments from there. As far as vacancy in the marketplace, I would say that we've had a little bit of an increase in vacancy, but not a significant amount. And that vacancy, I can't really, tie specifically to the pandemic. I think it's more, having vacancy that's for lease, because we've got a lot of owner users in our market as well, looking to owner occupy their own, property. So, on the sales side, we have a lack of product for sale. There's a couple new projects that are coming out of the ground, Herndon and Maple, Herndon and Chestnut, and then one in Clovis out near Cedar and Alluvial, where, particular companies will have the option to buy and purchase owner occupied real estate. There's not a lot of new development because we do have a significant amount of vacancy. For the most part, we're running around 16% across the whole market. North Fresno, obviously being a stronger market area and a more desirable location for most businesses, has been lower and still very competitive. We haven't seen any rent slipping. The biggest challenge when working in the sector around office building and doing office leasing done is that the cost of construction has gone up exponentially since the beginning of the pandemic, whether it be a lack of supplies. Even after the first of the year here, I think all developers or anyone building right now has seen a decrease in the availability of wood, cement, metal studs, a lot of different materials not being able to, the price either going up, anywhere from 20 to 40%, or just not even being able to get it. We used to be able to get metal studs on call, and now, a contractor doing a small TI job might have to wait 3 to 4 weeks to get metal studs. Delays in getting product, just laminate, products for countertops and doors and carpet. Carpet has been delayed coming out of Georgia. We had the large ice storm in Texas, which caused some delays and put production behind. I know a lot of the major plants are back there, and COVID-related shutdowns of plants over the last 12 months have slowed some stuff and got them behind on delivery, but not to the point where we can't do deals. It's just making it more challenging, and as costs go up, then the rents have to reflect that. So it's a scenario where I don't foresee that changing. And I mean, the cost for new builds, we still have a limited amount of land, and most of the parcels we have are larger. So you're not seeing a lot of small one-off buildings built. Again, much like we talked about before in earlier discussions, I think it's going to put pressure back on increasing values of existing properties. I think that, buying an existing property and trying to rehab it and occupy it, or trying to rehab it and rent it, I think will begin to be more and more of the norm than trying to consider, new construction.
We're hearing more about prefab buildings. Is that becoming viable in the Central Valley?
We have not seen it yet. I haven't talked to anyone that's been considering it yet, so I can't really give you a lot of input there. I think with the considerable amount of increase in cost, that being able to prefab a building in some manner would make some sense. But again, it's not really been tested here in our market. We do have a client on the industrial side that does the small houses, so I know they're very busy, which are a prefab, small little house, and they're doing lots of contracts with counties and cities all over the state. But from the office side, I have not seen that. I've heard more about it on the multifamily side, where they can do it in larger bulk, and obviously economies of scale. If you can do 200 units of apartments and prefab them, that's easier than trying to prefab a 5,000-foot standalone office building. But again, timeframes are slow, and getting permits from the city are getting more and more challenging and more detailed as far as the stuff that they want to see. Title 24 keeps changing, ADA compliance keeps changing. So, the tough part is you build a building today, and 12 months from now, it's probably out of code, and that's a challenging aspect for tenants and landlords. So, but overall, the market's been pretty strong. We did not see a lot of people struggling to pay rent during the pandemic, since most uses were more essential. And we're able to more easily work from home and remote. It's a situation where I think we're in a pretty good spot right now. I think unless, for some reason we see a really significant dip in the economy, I think the office market will continue to be steady. I don't think we're going to see a ton more growth, but I don't think you'll definitely see rents going down either in the Class A type locations.
Perfect. Thanks so much. The Zoom's cutting us close. Robin, multifamily, geez, it's been really hot. What can you tell us about what's going on there?
Well, I think we did this in July, wasn't it in July last year?
That sounds about right.
Yeah, I think it was 105. We were all sucking smoke and dodging the virus. And I look back at my notes from that meeting. What a change that has occurred, since then. if we just look back at where we were pre-COVID, we were year-over-year rent growth in our industry surpassed the Bay Area and Southern California by about 200 to 300 basis points. So we were averaging 4.5% to 6% year-over-year rent increase, whereas they were doing pre-pandemic about 2.5% to 3%. When the virus hit, it was almost like a tsunami of people flooding into the valley, Fresno in particular, but the Central Valley in general. People obviously taking advantage of the work from home phenomenon. So they said, why should I live in San Jose, the Peninsula, or the coastal counties at $3,000 plus? Why not move inland to the Central Valley and rent an apartment for $1,200, $1,300, $1,400 and still collect the $200,000 Facebook paycheck? And that phenomenon obviously affected the Valley, Fresno in particular as well. So that we really benefited from that work from home trend that occurred. Looking currently, what we're experiencing, obviously there's a lot of tenants, not a lot, but a good portion of tenants on some properties who couldn't pay rent, who declared the COVID hardship. And 3088, which was the Governor Newsom's bill that they passed back in August, starting September 1st, extended the moratorium to, at that time, to February or March 1st. And so we had to file paperwork, basically what you would call COVID hardship declarations. And so, obviously that impacted, especially some of the lower income properties, some of the smaller investors. Obviously in December, they passed the rental assistance and then further amplified by the $1.9 trillion. So what we're now dealing with, we're in the midst of, in all the counties, Fresno in particular as well, is the rental assistance program. And it is a godsend. The problem, though, is that there are a number of what's the word I'm looking for? You have to agree to a certain level of protections for the resident that some owners are choosing. I'd rather pass on getting the assistance if that's what I have to agree to. So that's still a work in progress. Each county is different. Each city is different on how they implement it. Some cities have very onerous restrictions on evictions and protections. Other cities are just following the basic guidelines. So that's still a work in progress in terms of the rental assistance. What's happened, though, is you have a situation where the eviction moratorium is created.
Sorry to interrupt you here, Robin. We're coming down to less than a minute, but I want to hear everything you've got. So
Okay.
Sorry about that.
The bottom line is that what we end up with is an environment of experiencing a lot of changes there. But nonetheless, it has been a solid industry, as Matt had mentioned. We had a very good experience with sales. Sales have been super strong. Rents have been super strong. So no complaints from the investment side there. So
Perfect. Thanks so much, Robin. And thanks so much, all of you, for jumping on this call now. We love it every time you guys come on.
Well, thank you for the opportunity.
Yeah, thank you.
Thank you.
All right, take care.